Hi, this is Jenny Kassan. I'm an attorney and coach for entrepreneurs that want to raise money for their business on their own terms. I've been doing this work since 2006, and I've helped hundreds of entrepreneurs design their fundraising strategies. I've also raised money for my own businesses 5 times. And I want to share a little bit about our model. And one of the things that we really encourage is to think a little bit differently about who investors are. So, the majority of the residents of the United States are investors. It's about 125 million people. And investors are incredibly diverse. This is in contrast to what most people think of when they think of investors. When they think of investors, most people think of what I call professional investors. And these are people who are actively engaged in investing in startups for a good chunk of their waking hours. So this could be active angels that are part of some kind of an angel group. This could be venture capitalists. These could be people that are managing money for wealthy folks, people that are managing some kind of an investment fund. That's what I call professional investors, but most investors are people in the US that have some money invested somewhere. And of course, most of their money is invested in the stock market, but they are investors. So if you look at the numbers of investors, only 0.3% of investors in the US are professional investors. Those people that self-identify as investors, that spend a lot of time thinking about investing, that might have the word investor in their LinkedIn profile. 99.7% of investors in the US are just regular folks that don't self-identify as investors, but they absolutely are investors, and these are people who could be potential investors for you. So this kind of gets into the question of different kinds of startup funding. So in the world of professional investing, most investors are investing on a model called the venture capital model. And this is a model where the investor is going to come in either with their own money if they're an angel investor, or with other people's money if they're a VC or investing for a fund, or investing on behalf of other folks. But basically, they're putting their money in with the expectation that your company has to grow really, really fast, really, really big, and the goal is an exit. So ideally, your company is going to grow in size by at least 10 times in 5 to 7 years. And after that, you'll be acquired by a larger company or possibly do an IPO, an initial public offering. If your business is not on that path, then the venture capital model is not a fit for you. But the good news is there is another way to raise money. I don't have a great name for it, but it's the non-VC style of raising money. It's raising money outside of that venture capital model. And you really have to pick which one you want. If you don't want venture capital money and you're not a fit for it, or you don't like the compromises and the trade-offs that go along with raising money that way, it doesn't mean you can't raise money from investors. It just means that you're going to be really on a totally different planet from the venture capital planet. And there are businesses out there who could raise money using the venture capital model, but they don't like the fact that they're pressured to grow the business fast at any cost. They have to sometimes sacrifice their values to achieve the goals of their investors. Their investors become their boss, and so they choose to raise money outside of the venture capital model. So when it comes to the universe of investors, professional investors, that 0.3% that I mentioned before, they tend to be investing on the venture capital model. Whether they're active angels, whether they're running VC funds, whether they're running a family office, even a foundation that's doing impact investing, they tend to invest using that venture capital model. And but non-professional investors, the 99.7% who don't self-identify as investors, are outside the box thinkers because they have never even been exposed to the idea of the venture capital model. They don't have any preconceived ideas about what is the right or wrong way to invest. Some of them might, but most of them are pretty open-minded, so that if you present to them an investment opportunity that allows them to make a reasonable return and get other benefits from investing in your business, they're not going to really care if you're raising money using that venture capital model or not, or if you're on that venture capital path. The overlap of these circles is designed to make it clear that there are some professional investors who are outside the box thinkers who are not investing on that venture capital model. But most professional investors are pretty darn stuck in that venture capital mindset. They're not open to other ideas. So if you want to raise money outside of the venture capital model, we highly recommend that you focus on that 99.7% of investors who are non-professional investors, because they are willing to think outside the box and be a lot more flexible. So what do we call this non-VC type of funding? Unfortunately, there isn't a really great name for it, but I'll share some of the terms that you might hear. Regenerative finance is something that some people are starting to talk about. This is a type of funding where the investors make a reasonable return, but the return is not based on that high growth model, which can be considered pretty extractive. It's extracting a lot of value with the goal of making a ton of money for the investors. Regenerative finance is more based on slow and steady growth, creative models that allow the investors to get paid but do not extract a huge amount of wealth for the investors at any cost. I like to call it creative fundraising, outside the box funding. Sometimes I call it we capital instead of VC, we see, because we're including everybody. We're not just including the professional investors. Sometimes people will talk about evergreen funding. This is because businesses that raise money this way are not focusing on an exit. They're focusing on steady, healthy growth that leads to sustainable profitability. So when you invest in these kinds of businesses, often there isn't some big exit, but you are making your returns by sharing in those profits that ideally are growing over time. Of course, we can just call it non-VC funding. Sometimes you'll hear people talk about alternative term sheets, and they'll say that because there is a standard term sheet in the venture capital world. So if you're not raising on the venture capital model, you'd be raising in a different way, which some people might call alternative. I don't love the term alternative, but you might hear that. And then some people will talk about retail investing, and that's because people who are not professional investors are sometimes called retail investors. So I just really want to encourage you to be knowledgeable about these two options. They really are incredibly different. Venture capital versus non-venture capital. The venture capital model involves focusing on those professional investors, generally speaking, the active angels. Maybe when you first start out, you're raising money from non-professional investors, but pretty quickly you're moving towards professional investors, because if you are on that VC path, you have to raise a lot of money very quickly, and you are going to be focusing on those accredited investors who are, active angels, and then eventually people who are managing other people's money. If you're raising money outside of the venture capital model, you're focusing on regular folks who are more open-minded about the type of investment that they would be happy to invest in. And so oftentimes those investors are incredibly different, and the messaging that you're going to be wanting to share with your potential investors is going to be incredibly different. So I highly recommend that you get to know both ways of raising money and pick the one that's best for you. And once you pick, really stick with that one, and don't let yourself get distracted by, we focus on businesses that are raising money outside of the venture capital model. And sometimes we find it hard for people to not get distracted by investment opportunities that they become aware of, because they sound so interesting, and oh, you just fill out this form, or oh, you just go pitch at this event. But what we find is most of those things do tend to be part of that venture capital model. And you just want to really double check, am I applying for funding or chasing after funding that is part of the venture capital model? If I'm not raising money within that model, I shouldn't be doing that. And sometimes it can be hard to tell. There are a lot of people that are investing using the venture capital model, but don't call themselves venture capital. So the way that you can tell if something is part of that venture capital world is, what are they looking for? Are they looking for that high growth company that's going to grow 10x minimum in 5 to 7 years and then have a big exit through an acquisition or an IPO? If so, that's the venture capital model. And if that's not right for you, just don't waste your time with those types of opportunities. I hope this was helpful. We have a lot more information to share. I'm going to put a link below that's going to share the 6 steps that we teach our clients to design a fundraising strategy that lets them raise money outside of the venture capital model and stay in control of their business and raise money on their own terms. All right, have a great day.